Alrighty. And we are live, I think. And okay, we seem to be live. How's it
We are
going,
live.
everybody? Serena and Fatma are joining me. I'm Neil, your host, and this is the Trillion Dollar Show. And we are, well, a sizable chunk of Tax Sherpa, anyway. This is our weekly show where we go over all the things that are happening in the tax world. We get people's questions and all kinds of fun stuff. So, we'll get into who I am in just a second here, but let me start the pretty slides. Let's see. There we go. So, um, this is the Trillion Dollar Show. I'm your host, Neil McSpadden. And quick question: why do we call it the Trillion Dollar Show? And the reason for that is because that's the mission: is to save Americans $1 trillion in taxes. So, you know, we're Tax Sherpa. We help people, especially small business people, save tons of money on their taxes. And there's a number of ways we do that through entity structuring, tax planning, all this kind of stuff. However, there is no scenario where McConaughey likes it. All right. There is no scenario in which we can work with enough clients in order to actually save $1 trillion. So, how do we actually do that? And the answer is scaling tax saving strategies through technology. So, you know, we're creating all kinds of stuff, tools, calculators, courses that can scale and can reach loads of people. And if those people put the tax planning strategies into place, they can save $1 trillion without actually too much trouble. So that's why this is the Trillion Dollar Show. That's the mission, and that's how we're going to do it. So who am I? I'm Neil. I went from owing the IRS over $1.3 million to zero, and in the process, discovered this whole world of tax strategy, tax planning that I had no idea existed before. So, in fixing my own mess, I started to get into this whole world, and I've been an entrepreneur my whole life. Well, my whole adult life, anyways. And I found out fairly quickly that there are kind of two categories when it comes to the tax professional world. So category number one are people who cater towards high net worth individuals, large corporations, and they by all accounts do a good job, right? And they save their clients, millions, sometimes billions of dollars, but they're charging six and seven figures to do that. The other 98% are basically the people who are have the small offices or franchise or whatever doing tax work, and they're kind of churn and burn. Uh, you know, they're they are the typical relationship is you go in once a year, say, "Here's my stuff," and they say, "Great." They put it in the computer and they say, "Here you go. Here's your tax return." Maybe you get a refund, maybe you owe whatever it is, just whatever it is. And that is okay if you have a very, very simple tax situation. So if you just have a W-2 and that's it, that's okay. If you are retired and don't have any active anything, it's just, passive investments and Social Security and whatever, that's okay. But for anybody who has anything complicated going on, it's not okay. It's because what happens is the people in that middle scenario are getting they can't afford, to spend $100,000, $200,000 on a tax return. And at the same time, by default, they're left with this other, churn and burn kind of tax filing system. And so they end up getting screwed because in that middle area, there's all kinds of things you could do. They take from the Wall Street kind of side of things and apply towards, more mom and pop type businesses. But, the people doing the churn and burn don't know how to do that or don't care. I'm not entirely sure which it is, to be honest. Um, and and then those people just left paying through the nose in taxes. So our goal is to change that. So that is how I came into this whole business and who it is that we aim to save with all of these tax saving tools. So the what, we have a bunch of courses. One of them is the starter course, and I'll show you how to get into all that later on. But basically, the starter course is for starting out, for people who are new into either business for themselves or maybe have a W-2 and are starting to go off on their own. It shows you kind of the basics, as far as like, how do you create a company? How do you set up bank accounts? What are the first things you should do from a tax perspective? And Makani is saying, I love it. I definitely felt that void. Yeah, absolutely. So the starter course, takes you through like step 0 to step 1, so that you are then in business in a tax efficient kind of way, and you are protecting your income as much as possible at those early stages. Once you get beyond that, then it's time for higher level stuff. But the starter course will do you for 90% of what people need to be doing, honestly. And then so that's the who, that's the what, and the how. The how is through these technological solutions. And then this is the part where we get into questions and answers. However, there's something um, I wanted to hit on today. So on on the 22nd, which was I guess Friday or Saturday, on Saturday, the Washington Post came out with an article, and they are citing um, three unnamed people that are working either in the IRS or in the Treasury Department, and they're terrified that uh, tax revenue is going to drop by as much as 10%, and that means it's going to cost for the government means lower taxes, $500 billion this year. And so anytime I see articles where there's anonymous sources, I feel like I've learned my lesson. So over the last several years, we've seen a lot of anonymous sources turn out to be just nonsense. It's just not true. So uh, I went ahead and I looked it up. Just hey, let's look up the information. So the Treasury is this. Let me make sure that this share is coming through. The Treasury puts out a report every month about receipts. So, in government accounting terms, a receipt is money paid from somebody to the federal government. So, like your income taxes are a receipt for the government. Corporation taxes are a receipt for the government. Your payroll taxes, Social Security, Medicare are a receipt for the government. And so, they publish these reports every month. And I was like, well, let's just check, right? So we're in the middle of March or towards the end of March now. But we have the January and February report. How does that compare to last year, right? So let's just take, let's take personal income taxes, individual income taxes. So this is this line in 2024. Let's see. So that was December of 23. So January of 24, $285 billion. January of 25, $308 billion. So 285 to 308. 308 it turns out is higher than 285. And in February of 24, 179 billion. February of 25, 193 billion. And again, 193 is higher than 179. So it's not true for that category, at least so far. Let's check social insurance and retirement receipts. Social insurance is Social Security, so those are those payroll taxes. So we just look at those. January of 24, 157 billion. January of 25, 163. So more people are paying more Social Security taxes. February of 24 is 129 billion. February of 25 is 134. And again, 134 is more than 129. So that is up compared to prior years, or like the last year anyway. And then if we look at corporation income taxes, corporation income taxes are very spiky. As you can see, they're also very low. Most people think that, corporations pay tons of taxes. It's not true. If we look at all these things together, it's personal income taxes are the most of the taxes, followed closely by Social Security. Corporate taxes are way down here. So, but if we zoom in on it, we can check the numbers. So January of 24, we're at 24 billion. January of 25, 26 billion. So that's higher. February of 24, 9.2. February of 25, 12 billion. So every category of taxes, customs duties and estate and gift, those are kind of uh, like almost unimportant. They're just rounding errors compared to all the other stuff. Uh, so all of these are higher in 2025 than they are in 2024. So if you were a Treasury official and you were saying to the Washington Post, well, we think tax revenue is going to drop this year, what could they possibly mean? I think what they mean is that people are freaking out about Doge, and this is a trial balloon to get the administration to backpedal on all this cost-cutting stuff. And I don't think it's going to work. So, you know, yes, I would love for the government to make $500 billion less off of us Americans. That would be great as far as I'm concerned. However, I don't actually see it happening. There's all these stories that I'm seeing on tax Twitter and stuff where people are talking to like it's tax professionals talking to each other. It's mostly them complaining, but it's people are saying it's like I talked to my client and he says he's not going to pay taxes because they're going to eliminate the income tax and all this kind of stuff. It's just not happening. I'm not seeing it. And maybe there's some people out there who think that, 2024 taxes are just going to disappear. I'm here to tell you that's not the case. They will continue to be in place. 2025 taxes are going to be in place, even if they pass a tax bill here in the next couple of months, which they say they're going to do. It will alter 2025 taxes, but it's not going to eliminate 2025 taxes. Even Lutnick, the Commerce Secretary, he's out there making the rounds on the podcasts and the TV shows. His proposal is no taxes for anybody making 150K or less. And our navigators group actually went over this in detail, but it's doable. So people making 150,000 or less constitutes 84% of the taxpayers. However, they only pay 18% of the income taxes. So there is a realistic possibility where if they get enough cuts from Doge and those cuts are instantiated by Congress, because Congress right now is still funding at the same levels as before Doge. So if you cut spending, but you're still spending the same amount, are you really cutting spending? I don't know. Um, so if they get real cuts done and they can afford to cut 18% of the income tax, as far as the total receipts, like we're seeing here, then that could be a realistic thing as far as like no taxes for people under 150K. And if that is the case, then great. And then, our job will shift to how do we tweak things so that, you're under that threshold. Now notice, when they talk about these things, they're talking about income taxes. And if we zoom in again here on just income taxes and social insurance receipts, you can see people pay almost as much in Social Security and payroll tax as they do in income tax. And some months, like this month right here, they actually paid more in Social Security than they did in income tax. So, you have to keep in mind what it is that you're hearing. So if they cut income taxes for people making less than 150K, that does not mean they're going to cut payroll taxes. Because if they did, Social Security would collapse overnight. So, you know, even if they pass something like that, you're still going to have, your Social Security. You're still going to have your Medicare taxes taken out. You're still going to have your unemployment insurance in some states. So it's not like magically you're going to get all of your paycheck, but you're going to get more of it if they do that. So there's that. I mean, and I'm all for more. Don't let the perfect be the enemy of the good. However, it's not quite the magic bullet that a lot of people think it is because there's multiple components. So that is my rant for today. The media are liars and don't listen to them.
That's so true.
Uh, anyway, anytime there's a news story that says unnamed sources or people familiar with the matter or whatever, if there's not a name, just ignore it. That's my rule.
Ignore it. Yeah.
All right, so on to the questions. Now we've been out for a couple weeks because we got married in extension season. So as corporations and partnerships are due March 15th, very few people are actually ready by March 15th. So we end up finding a whole lot of extensions, and that just took up all of our time for the last couple weeks. And then last Tuesday, I think I was just wiped out. So
I
uh,
agree. We were wiped out.
Yeah, so we're back on our regular weekly schedule, and I have the answer to every tax question that there is. And Serena, what's the answer to every tax question?
It depends.
It depends. And the whole Rest of the time here, I'll tell you about how it depends, because Serena has these questions that have come in from Fatma too. Uh, they have all these questions that have come in from clients that I don't know what the questions are going to be, but the answer is always going to be it depends, and then we'll get into what it depends on. But fundamentally, the the US tax system is very customized. And what I mean by that is that the the particulars are incredibly important. So the facts and circumstances around one taxpayer are going to be different than the facts and circumstances around another taxpayer. And so people who talk about it's like, oh, we should simplify the tax code. Well, people have been talking about that for 100 years. And every time they simplify it, it immediately gets more complicated again because it all depends on what the particulars are. So that's actually a good thing in that, you can get your tax situation to reflect your actual life. And you want to minimize that tax burden as much as possible, obviously, but also you want it to reflect accurately what's going on with you as opposed to just some kind of blanket rule that may or may not apply to your situation. So I'm of the opinion that the complexity of the tax code is actually a good thing because it allows us that customization. So with all that, what do we have going on here this week?
So we have a question that came in. Somebody wants to know what are the top three overlooked tax deductions for small business owners?
Top three overlooked tax deductions. Okay, number one is going to be an accountable plan. So an accountable plan is it's under section 1.62-2 of the code. And what that is if you've ever worked for a big company and you went to a trade show or something and you spent some personal money, you give your receipt to HR or whoever, and they reimburse you. That's an accountable plan. It's a tax-free reimbursement for personal funds that were spent on business stuff. So tax or small business people really, really underutilize their potential expenses. And I know that sounds crazy because some people go way overboard, but most people actually go undershooting of the potential deductions that they could get. And it's because, they're not properly tracking what's going on in their lives and what they're spending, and what they're spending that could be attributed to a business kind of expense. So a quick example that most people are familiar with is the home office expenses. So if you're a Schedule C filer, there is a form, it's 8829, and basically you list out your square footage of your office and of your total house, and then you can apportion like mortgage interest and property taxes and rent and whatever else goes along with that. And it'll spit out a number and it'll say, $1,300 is your home office deduction. So people are familiar with that. So the accountable plan can include the home office along with a whole bunch of other stuff. So you might be using your car for work for your business. You might be traveling for business. You might be, buying internet for your house for business. So like in my house here, I've got a business plan, and it's less used now because I was working out of the home office where I am now exclusively for about 5 years. But now, we've got the new office that we bought. So, all these kinds of things get included in accountable plans. And so that's number one overlooked deduction. Number two overlooked deduction, I would say, is the qualified business income deduction. So the qualified business income deduction was created with the Trump tax reform back in 2017. And what it is a tax break on pass-through income. So your Schedule C businesses, your Schedule E real estate, your Schedule F if you have a farm, your partnerships, your S corporations, all of those are pass-through income. And you can get a break of up to 20% of whatever that income is. So if you have an S corp and the profit's $100,000, you might only pay tax on 80 of it, which is fantastic. And the more you make, the more that percentage is in absolute terms. And the more powerful it is because you're taking off the top, which means that you are taking off at the highest marginal rates that you might pay. So um, so so one, people are just generally unfamiliar with that, but also people have no idea how to actually plan for it. Because what happens is if you're underneath a threshold, depending on your filing status, whether you're single, head of household, married filing separate, or if you're married filing joint, there's two different thresholds for those categories. Joint is one and all the rest are another. And if you're underneath that, you can get a flat 20%. But if you're above that, then there's a comparison test, and it's 20% versus 50% of the wages versus 2.5% of the assets in the business. And that all gets super complicated super quickly. And but it's an enormous tax deduction. I mean, 20% of your income could be, huge. I mean, we've had people who have like six-figure qualified business income deductions because we plan for it and because we optimize for it. In some cases, that means paying yourself more on a salary because you get that 50% of wage comparison point. And sometimes it means, optimizing the salary to be, maybe less. It all depends on the situation. But that's a huge deduction factor. And then the third one, I would say there's a tie for third for like a whole bunch of different things. Um, my favorite personally is the summit strategy sessions. And what that is our take on what you might have heard of as like the Augusta rule or the Master's rule or something like that. So under section 280 G2, 280A G2, there is a provision that was created in 1976, which just appears in the legislation one day, which is hilarious. But basically, if anybody rents out their primary dwelling for 14 days or less during the course of a year, then the income from that rental is not part of your taxable income. And so that's great. Anybody can rent out their place for any reason 14 times a year and not pay any taxes, just across the board. You could list it on VRBO. You could list it on Airbnb. You could just rent to a friend of yours for 2 weeks. Whatever. And that works fine, and that's an exclusion, which is great. But then, in order to really supercharge it, you actually have your company rented from you, and as long as it's a distinct tax entity, so you can't work for a Schedule C business. Um, as long as there's a distinct tax entity, like an S corp or something, that has its own address, then that works. Now, there's a lot of nuances that go into that. You have to make sure the number is real as far as like the rental. You can't just charge yourself $1 million, right? Um, it's got to be backed up by the market values. A second element is that people screw up on is they don't actually create a business purpose. So what we've done in our strategy is to create a monthly management meeting. So you get 12 of these a year because it's 12 months in the year, and we'll walk you through like how to actually look at your business as a business because the biggest problem that small business people have is that they're not formally trained small business people. They are really good at what they do. Like, you know, uh, let's say you're an air conditioning technician and you become really good at being an air conditioning technician. You go out on your own and you say, I can run my own business being an air conditioning technician. And sure, you can. But what you're missing is all the managerial skills, even if it's just you. All the stuff you learn in business school and all that kind of stuff. So uh, what the summit strategy sessions do is it forces you to sit down once a month and kind of go through your numbers and say, okay, here's how much money came in, here's how much money went out. These are the different categories. Here's how it compares to last month and last quarter and last year. And how am I going to review what happened in the preceding time? And what does that mean for the future? And what are my plans for the future? How am I going to improve my marketing? How am I going to improve my cost structure? All these kinds of things. And what it does is it one creates a business purpose, two, it creates a log for yourself, and three, it makes you run a better business. And all at the same time of that, you're actually getting a tax deduction because we've set it up right in the first place. So I would say those three are the three biggest, but the third one, it could be a lot of things, but that's my particular favorite. So that is that is my answer with several it depends built in.
Understood, understood.
Yeah.
Thank you for that, Neil. So we do have another question that just came in, and someone wants to know, is it better to take a salary or distributions from my S corp?
Well, is it too trite to say it depends? Uh,
I was going to say that too. It depends.
yeah. So if you have an S corporation and you take money out, then the first money out is required to be reasonable compensation for your services. So there's a lot of problems with this you know, issue. So nobody knows what reasonable compensation means because it's not defined anywhere. It's just like reasonable for your services. So, what are you doing? And then, there's a lot of constraining factors that goes into that. So one is that the company has to have enough money to pay it. So you are not supposed to anyway. You're not supposed to create a net loss by taking a salary from an S corp. But a lot of people hear the reasonable compensation part. They don't hear all the other parts. So we had one client who came to us, and in a couple of years ago, they took salaries of like $250,000, and they created a loss of like 265,000, which is just insane because you're paying payroll tax and all that. But you're going against guidance actually to when you do that. So um, so it's got to be reasonable. It's got to be affordable by the company, and it applies to first money out. And you want to think about, well, the salary portion determines what I can contribute to retirement plans, like a 401(k) or similar. So there's that factor. There's the the QBI optimization as far as how much salary do we want to take out, and then if you look at the court history of reasonable compensation, because this whole thing is an issue because of two things. So one is that you're paying Social Security and Medicare on your salary. So that's 15.3% extra. And you're not getting the QBI deduction on your salary. So that's a potentially 20%. So it's a 35% delta between profits, distributions, and salary. So there's a huge incentive to do more distributions than there is to do salary. That's why the reasonable compensation rule exists, because they still want to make sure that you are paying into Social Security. So, yeah, but you have to weigh all these balancing factors, and what is reasonable for you is probably not what you think it is. Because let's go back to the air conditioning tech. So, if I hired an air conditioning tech, full time, it would cost me a certain amount, depending on where I live, depending on how big a business I have, depending on what level of expertise that particular person has. And so, let's just say that's, I don't know, pick a number, $50,000 a year. If you are a solo operation and you are being an AC technician, do you pay yourself $50,000 a year? And the answer is probably not. And the reason is because you are not solely doing that one job. Any business owner is doing, 16 different jobs. And, what there are multiple approaches for how to calculate all these things. One of them is to actually take a journal and just log your hours over the course of, a week or two or three and say, okay, I spent 6 hours doing marketing. I spent 2 hours doing sales. I spent another 5 hours trying to chase down, people to actually pay their bills. I spent 3 hours doing email, and all these different things all have different associated, hourly rates with them. So if you were to go out and replace yourself with somebody out in the market for that job, and it's all going to depend on, your industry. It's going to depend on your location. It's going to depend on the size of your business. And there are tools for calculating all these things. So one I've used fairly often is RC Reports, and they'll charge you, I don't know, I think it's like $500 to calculate this report. And you can do that if you want, or you can do your own research on salary.com and things like that and try to figure out whatever is reasonable. But you come out with some blended average as far as a rate. So if paying yourself as an AC technician is $30 an hour, when all is said and done, you might be at like 22.18 an hour or something like that. It's usually going to be less than the pure job function that you think you're doing. And so that is, another constraining factor on how much you want to give yourself for salary versus distributions. So all of that is to say that distributions are heavily advantaged tax-wise, which is why they're trying to force you into paying yourself some payroll. Oh, I started to talk about the court history. So when these things go to audit, which is rare, and especially with all the layoffs in the IRS, it's going to be even rarer. When they go to court, the court asks the IRS, what should this person have paid themselves in salary? Almost always they come back with whatever the max that year for Social Security was, because that's what this is about. So just know that. So if you have a lot of net profit, you want to be looking at, say, well, am I in the ballpark of paying a lot of Social Security tax? If yes, then okay, let's have a deeper conversation and analyze all those different factors. If no, if I'm talking about, I have 20,000 net profit for the year, then well, one, you probably don't need any distributions or salary because it's only on money taken out. It's not necessarily on net profit. If you leave that money in working, then it doesn't apply. Um, so, you know, So you got to know what ballpark you're in. And on the other end of the spectrum, if you have $1 million worth of net profit, then you want to, yes, you're going to pay in the max for Social Security, whatever it is for that particular year, and you want to pay yourself more probably in order to optimize the qualified business income deduction. And then you can, you know, sock away a whole bunch of money for 401ks and that kind of thing. So there is no it's better or worse necessarily. It's, customized for your particular situation. So I know that's a long way of saying it depends, but basically it does.
No problem.
So,
Go ahead, Becky.
yeah. So do we have a questions from a client boss that asking, how can I legally pay my kids through my business and get a tax benefit?
Okay, so there's different ways to do this, and there's lots of ways to screw it up. So, so if you pay anybody from your business, then that's going to be a deduction to the business. So whether it's you or whether it's your kids, whether it's a stranger, anybody you're paying, a payroll check to is going to be a deduction to the business. So that's number one. The question then becomes, how do we supercharge that? And the answer is that if minor children, so under 18, are paid directly by their parents, and directly, it could mean a couple things. Then they are exempt from Social Security tax, they're exempt from Medicare tax, they're exempt from federal unemployment tax, and in most cases, they are exempt from state unemployment tax. Depends on the state, but most of them follow the feds on that one. So, and then if you pay anybody less than whatever the standard deduction is for that year, then they're not going to pay any income tax either. And sometimes there's differences between the federal and the state on that. So sometimes people end up paying a little bit on state income tax. So the real answer is you needs to be directly employing, which is going to mean either a Schedule C, a Schedule F, or a partnership, because those carry self-employment tax considerations. So let's just say you have a partnership, because that's typically the way we want to set it up. You have a partnership between you and your spouse, and you employ your kids. Now, I said they have to be under 18. Can they be five? The answer is no. They got to be at least eight, and eight is not a law anywhere, but it's emerged from court history of these things being challenged. As far as like eight is old enough to justifiably perform some economic activity. So there's people who talk about it, like, well, I put my kids on my business card, so I'm going to pay them as a model. It's like, okay, if you paid a kid a random modeling fee for 2 hours worth of work a year, how much is that going to be? It's not going to be a lot. So, so just wait till they're eight, and then you're more in the clear. So, uh, so if you have kids employed by a partnership that's directly owned by a husband and wife, then that's going to be, you know, under this exemption umbrella. It could be a Schedule C also, but partnership is better. So, um, so the kid has to be doing something. You can't just, wave a magic wand, right? So, um, and so like when they're younger, a lot of times when we talk with clients, we'll talk about it's like, okay, well, they can do janitorial stuff, they can start to do admin stuff, depends on the capability of the kid also. So like I have a now 11-year-old, she was 10 a month ago, but my 11-year-old does office admin stuff. So she opens mail, she scans, she shreds, and she does like office admin type of stuff. And I looked up, based on my local market and based on those particular job duties, it's like, what does that actually pay in my particular place? And so I gave her an hourly wage based on that. And so you can you can expand that as the child's capabilities expand. So when they're teenagers, a lot of times I'll have the kids be the client's social media directors or social media managers. So you can, they can do all your social media posting. They can do research on your competitors or client research or customer, survey kind of stuff. And they're actually generally better at it than you are. So it's actually worth paying them to do it. And it's a high value skill, and it commands a lot in the marketplace. So it's a high dollar hourly wage that gets associated with that. And then once you're in that zone, you can supercharge it even more if you start to incorporate the IRAs or other kinds of retirement plans. IRAs are the most common. So Let's say, the standard deduction this year for 2025, if for anybody, for a single person, is $15,000. So anybody who has taxable income of $15,000, or not taxable, but adjusted gross income of $15,000 or less, they subtract 15,000 from that. Now you're at zero, so there's nothing to tax. Okay, so anybody who's paid 15 grand or less during the year is going to pay zero income tax. And if they're under this arrangement, they're also going to pay zero Social Security tax, zero Medicare tax, zero unemployment tax. So it's tax free, and it's still a deduction to the company that paid them. So that's how we get all this to flow through to the benefit of the parents who are owning this company. Um, and then if we add an IRA into it, that becomes a Schedule 1 adjustment. This is a traditional IRA. So if you pay your kid $20,000, and yes, they have to do stuff in order to justify $20,000. If you pay your kid $20,000 and contribute 7,000 to an IRA, well, now it's going to be 20 minus 7, which is 13, which is less than 15, still tax free, still put 7 grand into the IRA, which is going to grow for 50 years, and it's going to be worth an enormous amount of money. Now, it is, as we're recording this, it's 2025. In 2027, there is a new version of the retirement savings credit that is coming out. I forget, I think they're just calling it savers credit or something like that. And what it is for low income people, um, right now, if you are low income and you contribute to a retirement plan, you get a non-refundable tax credit, meaning that if you owe taxes, you'll owe a little bit less because of contributing to your retirement plan. In 2027, that is changing to the government is going to put money into your retirement account directly, up to $1,000. So in in 27 and forward, in 27 and forward, if you are low income, which if you make 20,000, you're going to be, and you contribute to a retirement plan like an IRA, then the government is going to kick in $1,000 extra into that IRA. And it doesn't become taxable income. It just gets in there. And then when you take the money out in retirement, then it becomes taxable. But that's 50 years away. So I did the math on this. If your kids are the right ages, where you do it each year from age 8 to 17, 1,000 extra over that period of time, given average market assumptions and all this kind of stuff, you're talking about an extra $600,000 in your kid's retirement plan just from doing that. So uh yes, it's a tax deduction to the parents if you set it up correctly, and it sets your kid up for massive success later on. And I don't know why I can't talk anymore, but um really, really powerful strategy. Now, the main objection I get to this from parents is like, well, I don't want to pay my kid 10 grand or 15 grand or whatever the number is. I don't want to pay him that because then I'm out the money. And you have to keep in mind, it's like you're not out the money because you're spending money anyways, right? You're spending money on kids' clothes, on camps, on video game, whatever it is, right? And so now going forward, you just spend their money because you're still the parent, you're still the custodian of these accounts. So whatever money you were spending, there's now you're spending their money. And you will be amazed at how economically conscientious a kid can get if it's their money that's being spent. It's like, well, I want to buy rollerblades. I want to buy this. I want to buy that. It's like, okay, here's how much you have in your account, and then we're going to spend it. It's like, whoa, 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 wait a minute. Let's back up. And so you might find yourself being a little bit more uh, cost efficient that way. Now, another thing that people always bring up with the kids is like, what about private school and that kind of stuff? Private school is not deductible. But if you pay your kid and the kid's paying for private school, then that works because you're paying the kid. So that mechanism actually solves a lot of problems, and it's definitely worth doing. And you get to teach your kids all about making money, saving money, investing money, spending money, all these lessons that are really, really valuable, as they're growing up and going into adulthood. Because I don't know about you guys, but I learned like nothing about money when I was a kid, and uh, so I've got two sisters. We all got into financial trouble in our 20s because I think that's just kind of how it worked out. But had I had a little entrepreneurial education prior to that, I think I might have done better. But everybody's going to be different. So that's how you do it, though. You set up a structure so that you can pay them. You got to pay them a reasonable amount based on what it is that they're actually doing, and then you can supercharge it potentially with with the retirement strategies.
All right, thank you, Neil, for that. We have another question that just came in. Someone wants to know, what's your advice for someone switching from a W-2 job to self-employment?
Okay, number one, do it.
I was going to say that too.
Yeah. Yeah. So once you go from W-2 to self-employment, I mean the whole world changes because you're switching your category basically. So people have a very mixed opinions on Robert Kiyosaki, but I think he's massively misunderstood. But he came up with this idea of the B or the cash flow quadrant. And basically it's four sectors, and one is employee, self-employed, business owner, and investor. Now the particulars don't really matter. But the fundamental difference is that as an employee, you are the most restricted because they get you upfront. So when the income tax was created back in 1913, you just filed stuff once a year and you paid once a year. That was it. And then World War II comes around, and the government wants more money. So they passed the current Withholding Act. I think I'm missing up the name there a little bit, but basically it was Milton Friedman's brainchild, Mr. Libertarian of all the people, said that well, if we collect the taxes up front and do withholdings from their paychecks, then we don't have to rely on them so much to file at the end of the year because compliance was not high. So ever since World War II, the government has been taking money out of people's paychecks directly, and that's the system we have today. So Social Security tax, Medicare tax, income taxes are all grabbed up front, and you can only do your best to get back what you can on the income tax side. Social Security, Medicare tax, that money's gone. You're never getting that back because it's already spent. But for income tax, you can file and say, well, I didn't actually make as much as I thought I was going to, so you owe me some of that back. But you're limited in that situation significantly. Um, Whereas scenario two, you are owning your own business. Whether you're a contractor or 1099 or whatever, you're still owning your own business. And a lot of people don't understand that. But once you're controlling your own destiny, then you have options. It's like, well, how much do I want to pay myself? Like we were talking about with the reasonable compensation. Do I want to contribute to retirement plans? Do I want to create tax-free benefits? Do I want to do this? Do I want to do that? Do I want to be structured as a partnership, an S corporation, a Schedule C? All these different choices are become options once you are self-employed. And so your tax efficiency is going to be, assuming you have any degree of planning, is going to be vastly better on the self-employed side. So, you know, if you're a W-2 worker, you might be familiar with the fact that contractors make more. And the reason for that is that the employer does not have to cover employer taxes, which is 7%, and they don't have to cover unemployment, and they don't have to cover um, uh, you know, it's the liability insurance. I'm blanking on the term, but basically it's 10 to 15% cheaper to hire a contractor than it is to hire an employee. And so that cost savings gets passed on to the contractor because you're still competing for labor. So a contractor off the bat is going to earn more because those cost burdens are shifted to the contractor. So that's number one. But the biggest difference is that an employee gets taxed through the current withholding taxes, and then has the remainder of their take-home pay to spend. A small business or any business earns and then spends and then gets taxed on the remainder. And so that difference in order makes all the difference in the world because you can choose how much or how little to spend, and that's going to dictate what your tax situation ends up being. So to put like figures to it, basically given the same amount of income, if you have anybody in your corner at all when it comes to tax planning, you're going to pay half as much as a small business person than you are as an employee. And that's definitely worth doing. And maybe that means you can do less work. I mean, I've seen people take that option. It was like, well, we had a client just the other day who was a big W-2 employee at Facebook or Meta or whatever it's called, and stopped doing that, started contracting for herself, and is bringing in a little bit less, but take-home pay is actually the same because she's working less but has more flexibility, and she's taking that flexibility to take care of her daughter and all this kind of stuff. Um, but our standard of living remains the same because, it's just more tax efficient on the contractor side. So, so yeah, I think everybody should be in business for themselves. And I get pushback on that, but that's still how I feel. So, so I still say just do it. I think you'll be better off.
Understood.
And we have another question from a client boss that what's the difference between an LLC and an S corp for tax purposes?
Aha. So, an S corporation is a particular classification for corporations. You have to have like 100 or fewer. They keep changing the number on this. It used to be 25, then it was 100. You have to have a small number of people as owners. You can only have one class of stock, and it's a pass-through structure. So, like a big corporation, a C corporation, is like, let's say Tesla or Apple or IBM or, any big company that's publicly traded is pretty much going to be a C corporation. The C corporation pays its own taxes, and that has particular advantages and disadvantages, but a S corporation is a pass-through. So all the stuff we were talking about earlier with reasonable compensation and qualified business income deduction, those all come into effect because it's pass-through, because the income, files its own tax return, but then the income flows through to the owners through Schedule K-1. So that's what an S corp is. But an S corp is not a type of corporation. It is a tax status. It's an election that you make with the IRS. And in New York, you also have to make it with the state. So, you know, so an LLC is limited liability company, and for tax purposes, LLCs do not exist. They are what the IRS calls creatures of the state. And what that means is that there is no federal designation or federal recognition of LLC. And so the net result is that, you file an LLC with your Secretary of State in whatever state you're operating in, and then you have to go and tell the IRS, hey, I have this LLC for tax purposes. I'm going to be X. And it could be anything. It could be C corporation, could be partnership, could be an S corporation, could be a disregarded entity where it's just completely gone as far as tax purposes go. So um, so they're two totally separate things. So you could be a corporation taxed as a S corporation. You could be an LLC taxed as an S corporation. You could be an LLC taxed as a partnership. You could be an LLC taxed as a C corporation, or you could be an LLC taxed as a disregarded entity, meaning that you're just flow through to whatever owns the LLC. And so one is a legal designation, so that's the LLC, and one is a tax status, which is the S corporation, and they may or may not have anything to do with each other. So, um, a lot of people do get confused by that and say, "Well, I thought I was an LLC. Now you're telling me an S corp." It's like two different things. One's legal, one's tax. That's just how it is.
All right, so we have another question that came in. It's a business tax question. So someone wants to know, can I deduct 100% of my car if it's used for business?
If it's 100% used for business, yes.
Yeah,
If it's not 100% used, then you gotta prorate it.
right.
So we've had clients. This happens a lot in security business, where the companies that go around neighborhoods and they'll have their car and they'll have their logos on it, and they're going around throughout the day and night and checking up on things. So we've had clients in that business, and they have like 7 cars, and all the cars are used by their staff to do business, to do the work of security services. And in those cases, yes, 100% are used for business, 100% expense on the business side. If you're using your personal car and you're using some for personal, some for business, then you got to apportion out which is which. And you can take deductions based on the business part of that. So, um, so yeah, it depends.
So that is a it depends question.
Yeah. Yeah, and I will say that as an advanced technique there, it gets into the home office establishment. Because the, I don't know how deep I want to get into this, but basically, your commute from home to work is not deductible. Everything after you get to work is deductible. If your work is at your home office, then that expands the range at which you can have business travel. So that's just something to keep in mind.
Understood.
Okay. Also, boss, we do have another question, which is how do accountable plan works and should I have one for my business?
So one, yes, you should have one. Even if you don't use it, you should just have one. And it's there's some kind of boilerplate plan establishment language. Technically, an accountable plan doesn't have to be written, but it should be. So how it works is you define a couple of key parameters as far as like, when can I reimburse myself? How soon? Because you can't say, oh, I need to reimburse this thing from 5 years ago. Usually it's like a 60-day window, something like that, as far as expenses. How you do it is uh, the way I like to do it is you have your summit strategy session, and in that management meeting you're having with yourself, also in that same time, you go through a reimbursements procedure. And you say, okay, the last month I spent all this money on this, that, and the other, and you have a list and how much and what percentage is business, and then you take a reimbursement payment from the company to yourself. So, that's basically it. You just transfer money from the business to your personal account for the purpose of reimbursing whatever the expenses are. So you got to have a list of expenses. You got to know how much. You got to be able to justify at least to yourself and potentially the IRS at some future date, that it did have a business purpose, and then actually effectuate that transfer. So, um, so as far as like what are the physical mechanics? Well, you can log into your business bank account, click transfer, put in a dollar amount, and that's it.
All right, so it's 5:51. Well, my time is 5:51.
Yeah.
Neil, do we have time for another question?
Let's do one more.
Okay. So we had one that just came in. They want to know about writing off improvements made to their rental property. Is that allowed?
Yeah. So it depends here is whether it gets expensed or capitalized. And it depends on the type of improvement it is and how much it is. Generally, kind of $4,000 is kind of like a threshold. Um, and like if you're doing structural improvements, then that's going to be capitalized because you're physically adding into the overall capital structure of the building. If it's I repainted, well, then it kind of depends on how much. Are we doing a whole thing where it's the whole house inside and out, or am I repainting a room that's $800? So at that point it starts to get a little more granular as far as how you do that. So one of the things that's going on in Congress right now is a negotiation over bonus depreciation. So back in 2017, when the first version of the Trump tax reform went into effect, we got 100% bonus depreciation for all kinds of stuff. And the reason or the rationale for doing this is they wanted to incentivize businesses to buy into equipment and capital and factories and all this kind of stuff. So basically, everything short of 27 and a half year um, real estate. Basically everything that was under that, like 15-year property, 7-year property, 5-year property, 3-year property, that all became bonus depreciation of 100%. And so effectively it was the same as just writing it all off in the year that you bought it. So there was kind of no difference between expensing and capitalizing. Now, as the Tax Cut and Jobs Act gets closer to expiration in 2026, that bonus depreciation has shrunk because well, I don't want to go into all why that happens, but basically we're losing 20% a year, and right now we're at 60% of well for last year. We're at 60% for the bonus depreciation. What they're talking about right now, and one of the things Trump said in one of his speeches was that he wants to instantiate 100% bonus depreciation for all assets purchased after January 20th, 2025. Now that has not passed yet, but that's in the active discussion. So if assuming that does go back into the code, the tax code, then we'll be back into the situation we were in, where effectively there's no difference between capitalizing an asset and just buying it and expensing it directly. So so hopefully that does pass in whatever bill they end up on. I think it will, and yeah, that'll be great for anybody who is spending money on capital stuff like, real estate improvements. So, um, that is a case where eventually it might not depend, but right now it does. Oh, we got a question here from Melissa. Does that mean your kids' income wouldn't need to be reported on your taxes since you claim them, or they have to file a separate tax return? They would have to file a separate tax return. Yes. So anybody who has earned income. So, all right. It depends on the state. So if you are underneath the threshold for a standard deduction, then you might not have to file at all. But sometimes there's differences between the federal not having any taxes and the state. And so you do have to file because there's a state obligation. Or if you're over the standard deduction and you're playing the IRA approach, then you want to then you still have to file that because you need to tell the government, hey, we were over the threshold, but now we're under because of the IRA contribution. But yeah, the kids file their own tax returns, and they're still dependents. They're still claimed by the parents, and yeah, they're just in a zone where they don't have to pay any tax. Also, people sometimes ask about the kiddie tax, and that's for investment income. That does not apply to earned income. So as long as their investment income isn't crazy, then you don't have to file kiddie tax issues. All right, so that is all of the it depends for this week. Anyway, let's go back over here. And so what next? Next thing to do, if you're not already, is become an explorer. Go to taxsherpa.com/explorer. You can sign up. It's free. You get access to a lot of our stuff, as far as our courses and calculators, some of our custom AI software, which is being added to. It's kind of slow right now because we're in the middle of tax season, but but I am working on stuff behind the scenes, and I think after April, I'll start releasing a whole bunch of stuff rapidly. This last month, I actually upgraded the quick and dirty bookkeeping. So, bookkeeping is one of these things that is the bane of my existence. So, everybody needs to do bookkeeping. Nobody likes to do bookkeeping, and nobody wants to pay for it. So, what I did was instead of people still send me bank statements for filing taxes, I don't need bank statements. I need profit and loss statements. And so what I did was I created a system that will take your bank statement and it will process that with AI, and then you copy and paste that into a pre-formatted worksheet, and then it will spit out a P&L for you. So you can do a month's worth of bookkeeping if you have a simple business. You can do a month's worth of bookkeeping in 5 minutes. And I've done it many, many times because when clients send me bank statements, that's what I do. So, uh, I upgraded that about a month ago and created version 2, where it does a more accurate job of separating the different pieces and categorizing things. So that is there in the Explorers group. You go to the Learning tab and you'll see the quick and dirty bookkeeping. Kim says she's used it. It's very cool, very easy. Yeah, it's you just upload a statement. Just do one at a time. That's the only thing. Because if there's too much data, it gets lost. But you just do one at a time, copy paste, one at a time, copy paste, and it makes my life easier. And it's my hope that all the small business people out there will start to use it and will start having their own financials, with which you can then do summit strategy sessions because you need that information in order to plan ahead. So it all works together. Um, so so if you haven't, become an explorer, and then we'll see you in the next week. We'll do this all over again because we're back on our regular schedule, and yeah, we'll see you on the inside. And Kim says if you have a lot of data, do one page at a time. Absolutely. All right. With that, we'll catch you later. And if you have any questions, go ahead and email them in. Just go to taxsherpa.com. You can contact us. And who knows, your question might make it on the show next week. All right.
Alrighty.
See you guys later.